Hello and welcome. This is the earnings special. Well, the first of the Nifty numbers are out, and by that I mean Infosys. The earnings have come through, and we're looking at a fairly stable quarter and not much firework, and well, largely in line if I disregard what we were expecting with respect to margins. But before I get through to the details, let's just address the headline numbers. Now, starting off with your dollar revenues, we're looking at an uptick of around 2.4% sequentially at around $3,060 million, and this is absolutely in line with the Bloomberg Quint poll that we've run at around 3,065. Moving on to your revenues, again at 21,539 crores in rupee terms, absolutely in line with the Bloomberg consensus of 21,462. So not much change there in the revenues, very much in line with what the street was working with. Perhaps a negative surprise is where we're seeing when it comes to margins. So on an adjusted basis, if you take out the 451 crores as a devaluation for Pana and Skava in the base quarter, you're looking at an adjusted EBIT of 4,618 crores, which is a decline of 4.4%. Thereby, you're getting margins of around 21.4% for this particular quarter against 22.6% margins sequentially, and that is a big miss out there because we were working with numbers of around 22.6%, and what we've got is 21.4%. So a big miss when it comes to margins. Consequently, of course, this will have an impact on the profitability. So when it comes to your reported profit, that of course rises by 13%, and of course your adjusted profit up 2.2%. But perhaps what is even more important in these set of earnings is it was the fourth quarter, which means we have guidance for the upcoming financial year. And when it comes to your top line guidance, that is fairly in line with what the street was working with. So your revenue growth in constant currency for the entire financial year of FY20, we have 7.5% to 9.5% growth. And when it comes to operating margins, that is at around 21 to 23%. I would say a drop of around 100 basis points from the margins that were put out by the company in the previous financial year. On that note, let me get in our experts for the day. We have Dipesh Mehta, Senior Analyst at SBI Cap Securities, who's joining us on the phone line, as is Madhu Babu, Analyst at Central Broking, who is also with us. Madhu and Dipesh, thanks both of you for joining us. Madhu, let me come to you first. What are you making of the numbers? What's your initial take on this one?
So it's a clear disappointment on the EBIT margins. So in fact, last 3 quarters itself, the margin trajectory has been weak, and they have cut their guidance for margin for FY20, so 21 to 23. Earlier was 22 to 24. Right. So you will see a slew of EPS cuts from the market. I think at least a 4-5% EPS cut is comfortably going to happen post this result. Growth-wise, I think it is fine. Deal wins have been strong. Next year guidance has been also decent. I think they have been a bit conservative, but we are comfortable that Infy could grow next year 9-10%. Very comfortable on the growth side. But I think margins will have to reset lower.
Okay, Dipesh, what do you make of the headline numbers as well as the guidance?
I think I broadly agree with Madhu in terms of where disappointment comes in terms of margin performance. And on revenue side, I think performance is tracking broadly in line with what our expectation for Q4 as well as for guidance. On Q4 side only, I think some of the vertical growth performance seems to be weaker, particularly on BFSI side.
Okay, Dipesh, can you elaborate on that? What were your expectations with respect to BFSI, and what have you got right now?
So there was no specific expectation, but this time BFSI seems to be negative QOQ.
Okay, Madhu, anything that stands out for you in the vertical specifically? Because there was a lot of talk about banking and financial services finally getting on track over the previous 3 quarters, and now we're looking at, well, perhaps some concern.
Yeah, so BFSI, there's not much of sustainable recovery. I think even if you see recent Accenture results, they have not shown good performance in BFSI.
Okay, so then Madhu, where is it that the company has been doing well? Because if the revenue growth is largely in line with expectations, then there must be something which must be actually doing well as well.
See, some of the new deals are coming with on-site rebadging, etc. A different cost structure, and there's a lot of on-site intensity increasing in the business. So these are all the things, and of course the rupee has appreciated this quarter. So all these have hit on the margins.
Okay. Dipesh, what do you make of the guidance, especially the operating margins? If you can come in on that, is this as per your expectations?
So 21 to 23 is broadly in line with our expectation.
Okay, and can you tell me about the factors that could have played a part in the guidance out here? Would it be higher people costs and subcontractor costs?
So that is one of the factors which is playing out in terms of supply side challenges what they are facing. Second is, I think Madhu earlier indicated about rebadging related and the number of large deals which they are signing. So some integration related cost and obviously rupee appreciation which we have seen in recent past.
Okay, Madhu, we have spoken about this increase in people costs, of course, in the past, but there is also this element of investments that the company has been suggesting that because of high investments, it could actually impact their operating margins. What do you make of the operating margins guidance yourself?
So actually, I think only TCS, Infy are currently at relatively higher margins, whereas if you say Accenture is at 15, Cognizant is at 21. So obviously, I think Infy is guiding that, okay, that this kind of margin is difficult to sustain in this kind of cost structure and, competitive environment.
Okay. And perhaps a final question, if I can take this up with you, Madhu, what are you looking forward to from the management commentary?
So I think mostly the questions will be around the margin and, what are the levers from here.
Okay, and Dipesh, how about you? What are you keeping an eye on when it comes to management commentary?
I think two comments would be important. First is about the margin and how they expect margin to recover, because Q1 you will see salary hike playing out, and that time margin is likely to be even lower than Q4. So their guidance implies there would be sustained recovery in next 3 quarters. So that would be how they expect margin trajectory to play out. And second thing would be about overall vertical-wise outlook, how they expect BFSI to play out.
Madhu, if I can come back to you just on one or two more odd questions, can you tell me about the retail vertical as well, because it is a fairly important one. What kind of trends are you witnessing? Are you seeing a volatility return to this after we saw some quarters of stability there?
Yeah, so retail has not been a sustainable recovery because you're still seeing weakness, right, in developed markets because of the Amazon effect. So there will be one quarterly volatility on this. I mean, we cannot call out that it's out of the woods.
Okay, and Dipesh, if you can also give me an idea about this investment aspect too, because that is something that the company has suggested. So do you think, Dipesh, that the investment proportion will remain the same for this particular financial year as well, which could have also an impact on operating margins?
What investment you are referring to? Sorry.
Okay, so in the previous quarter, the management has suggested that there is a 20 basis points hit because of added investments as far as your overall business is concerned. Do you think that could also be a deterring factor when it comes to margins going forward?
So the investment, I think, maybe which you are referring to is about the business model change as well as digital and on-site model and all those things. It might be referring to. My sense is absolute amount might be there. As a percentage of revenue, it would likely to start tapering off as we enter into end of FY20 kind of thing.
Okay, Dipesh, if you can just hold on. I just want to reiterate some of the quotes that our management have suggested. So I'm going to take a quote from Salil Parekh. He says, "We completed the first year of our transformation journey with strong results on multiple dimensions, including revenue growth, performance of our digital portfolio, large deal wins, and client metrics. This is a reflection of our increased client relevance stemming from our focus on digital positioning, long-standing client relationships." Again, Dipesh, if you could come through on the digital portfolio as well, the digital aspect. Do you think that the growth could be as robust as what we have seen in the past financial year? And do you think that could remain a driving factor when it comes to growth in FY20 as well?
I think so. I think digital is likely to be a key growth pillar for next year as well.
Dipesh, thanks for joining us and taking us through your views on, Infosys, your initial take on the quarterly earnings. So there you have it, guys. We're just waiting for the management to speak to us in their quarterly press conference, of course, where we will have Salil, Parekh, the CEO and MD, as well as Pravin Rao, and of course Nilanjan Roy joins us, joins Infosys as the CFO. And of course, this will be his first quarter since we had Ranga, and then eventually we had another interim CFO. So we'll have a word from the management of the company. Again, when it comes to the numbers, looking fairly in line, but the clear problem and the clear challenge in this case is, of course, the margins, which have come off quite substantially for this particular quarter. So, we're keeping an eye on that one. And of course, as far as your several other aspects are concerned, another very interesting, variable which comes out of this particular quarter is the total contract value for the fourth quarter stands at around $1.5 billion. Now, over the previous two quarters, that is quarter 2 and quarter 3, your total contract value stood on an average at around $1.8 billion. We were expecting a higher total contract value, but that really hasn't come through for this particular quarter. So we're going to have to wait and watch as to whether or not the management is looking at some sort of, uptake in the upcoming quarter. That is the first quarter of FY20. That said, when it comes to financial services, so that's your clear picture. And, as our analysts were expecting and suggesting that there is a little bit of weakness when it comes to the banking and financial space. So that particular vertical is certainly not out of the woods. But what is also very surprising is the fourth quarter's retail contribution, and I am uncertain because that looks very, very big. So, but if it is, I mean, it's 32%, contribution to revenues is substantially wrong. Okay, so I've been told it's incorrect. So we'll get you that. Of course, we all know that North America, with a 61.2% contribution, we all know that is its largest space. And I'm going to, get an idea from again the management, not necessarily us in general, about how North America has done, because Q2 and Q3 were fairly strong for the company, but again, we're keeping an eye on that one. Of course, Europe has remained volatile for the entire sector as a whole, though it's not been as bad when it comes to the previous couple of quarters, so we'll be watching out for that as well. Among many other factors, we're also keeping an eye on, dividends and buybacks. And of course, as we all know, that now this has become fairly standard procedure for your information technology companies, at least the larger ones, to, along with dividends, also consider buybacks, as we have seen in the case of the last 3 years. So, to take you through comments from Nilanjan Roy, who is the new CFO of the company, he says that cash generation for FY19 has been strong. Then the dividend per share policy has increased by 4.5%. And during the quarter, they've completed, complete a payout of special dividends in January and initiated a share buyback program. And he is also suggesting that we have had another quarter of forex gains thanks to a proactive hedging strategy. So again, that'll be another key factor to watch out for. But I think we will have the management talk to us in just a few moments. So until then, of course, we can keep an eye on several other factors that are coming through in the press release. Okay, I think we have Salil Parekh talking to us, so we'll just go across.
And, thank you for being here today. It's really an exciting day and announcement evening for us and me. It's our first full year, and from my perspective, it's been really an incredible year that we've had as a company. Obviously, you've seen the press release, but I'll give you a few of the highlights. I'm truly pleased with the sort of results that have come about and with the transformation we've driven this year. And the results demonstrate some of the first steps of that transformation. We have increased our client relevance, and that shows up in our full year growth. A full year growth is 9% constant currency, and in the quarter it's 11.7%. So an incredible year for growth and further acceleration in Q4. Our sequential growth constant currency basis is 2.1, which is yet another strong quarter for us after the first 3 quarters of the year. Our clients are seeing more and more value with our digital portfolio. This was driving our full year growth. So full year digital growth is just at 34%. And the Q4 growth for digital is 41%. So we see again that all of our investments in digital are resonating with our clients. And we can see that this is further accelerating in Q4. At the end of the year, we now have 34%, just over a third of our revenue coming from digital. To give you one example, we are really delighted that our digital banking platform has gained tremendous traction in this fiscal year. We have 7 new global logos on our digital banking platform. That's a real achievement with the way we've repositioned that platform, re-architected it, and driving the digital agenda. We've seen our clients select us for critical work across data, analytics, cloud, IoT, cybersecurity, all of the elements of our digital pentagon. On large deals, again, we had an exceptional quarter, 1.6 billion in new large deal wins. From that, a total of 6.3 billion for the full year. That's twice the value we had in fiscal 18. Again, our investment in sales are starting to help us build the momentum that we need. And we can see that in the number of large deals. And in fact, you'll hear some more stats on the net new in a short while. Our engagement with large clients is also growing well. The number of large clients over 100 million in revenue has increased to 25. It was 20 this time last year. What we see now is our planned investments in sales and in building a business model which is resilient via localization in all of our key markets. That's starting to pay dividends. It's yielding benefits. Our margin for the full year was within our guided band at 22.8%. And our margin for Q4 was at 21.5%. Going forward, we see the ability now to drive operational efficiency into our business. Overall, we see our business being more stable and better positioned to benefit from the shift to digital in the years to come ahead, and also to build business resilience into our model. All of that leads us to our guidance. Our guidance for fiscal 20 is revenue growth in the range of 7.5% to 9.5% in constant currency, and margin in the range 21% to 23%. I'll pause there and we'll open it up for questions. I also want to welcome Nilanjan, for whom it's the first interaction with you in this formal capacity. And we all look forward, Pravin, Nilanjan and I, to address your questions. Go ahead, please.
Thank you, Salil. Before we open the floor for the Q&A, I would like to reiterate, please ask one question per publication. And we'll begin with the electronic media. And the first question is from CNBC.
Hi, this is Mugdha from CNBC. Firstly, congrats on a great quarter and a great year. My question to you, Salil, is, why is the guidance so low at 7.5 to 9.5%, especially because you've doubled your deal wins? Why is it not reflecting the accelerated growth? To Nilanjan, I have to ask, why have you cut margin guidance by 100 basis points? And why was the Q4 margin at, 21.4%, which is much lower than expected? And to Pravin, attrition is still high. You've mentioned that in the press release as well, despite steps being taken by the company. What more are you doing? And, would this impact margins going forward?
So let me start with the guidance. I think the way we construct guidance is looking at what we've done in terms of the full... full year in the new wins, but also making sure we look at what's going on in the market. We have a very strong acceleration for the full year, and therefore guidance, if you recall, for fiscal 19 was 6 to 8, and we've now bumped it up to 7.5 to 9.5. So from our perspective, it's a very strong movement of the guidance in the growth direction. So we've not actually cut it in that sense because we had a guidance this year of 6 to 8. We've delivered 9%, and this 7.5 to 9.5 fits very well within the range of guidance, within the range of growth that we anticipate for the full year.
Yeah, on the margin question, I think I'll just step back and go back a year when the new Navigate Your Next strategy was announced. And I think there were 4 key pillars which the company set forth. One was, of course, building the digital framework. And that, of course, has led to the increased growth. But this also called for additional investments, which we had to make in digital talent throughout the year. So one of the reasons of the margin impact has been the investments we have made beyond digital, getting new digital talent into the company. If I look at the second framework for the Navigating Your Next was about energizing our core, which is basically how do we get automation and AI and drive efficiencies in the operations during the year. And many of these are, of course, in our business passed on to our clients. And I think during the last year, we have seen about 90 basis points actually of margin efficiencies coming through the various levers which we have. The thirdly is, I think, in part of the strategy was localization. This is a very, very important future-proofing for the company. In the United States, we have been setting up innovation hubs. We are, I think, ahead of the peer set. We have set up 5 hubs across the US, and also hiring local talent in a global delivery model to de-risk our business in the future. And I think this is an investment which we believe is much required, and I think that puts us to build a much more robust framework and a model for the future years. And of course, the last was about reskilling our people. And I think as part of that as well, the investments we have made into refactoring our employees, I think that's also been the investments we've made. So I think as we guided the market at the beginning of the year, although we ended last year at 24.3, our margin guidance was between 22 to 24. So we had seen these investments coming, and we ended at 22.8. So I think this has been a thought-through program. And the guidance for next year actually reflects the margin of where we are from Q4 and how we build forward.
On the attrition front, attrition is definitely higher than where we anticipated. It's increased slightly from 17.8 to 18.3 at Infosys Limited level. There are multiple interventions we have started in the last quarter or so. We have come up with a new employee value proposition, which is focusing on engaging better with employees, enabling them, creating more career opportunities, and providing them a very rewarding experience. So there have been many interventions we have done in the last quarter. Some of this will take time to yield results, and we are also looking at wherever there are gaps in compensation, or we are trying to fix that as well. The primary, when we segment the attrition, the primary areas where we are seeing challenges are people with 3 to 5 experience here, and probably about 2 to 3 years experience in US. So that is a segment we need to address, and we are also introducing milestone-based increments. We are also now encouraging people to get certified, become digital specialists, and then we are coming up with incentive scheme for people who have what we call internally as digital tax. So I have multiple initiatives underway, both addressing any hygiene issues that we have, as well as some of the new things. And part of it is also about better narrative about the kind of opportunities we have, kind of investments we are doing in terms of their own career progression, career enrichment, and so on. So we expect in the next couple of quarters things should become better. But there's something we constantly focus on, and we understand that this is a critical thing. And we want to bring it down to 13 to 15%. That's where our comfort is going forward.
Next question is from ET Now.
Hi, on your left. Hi, everyone. Rahul Dayama from ET Now. Salil, my question to you is, even last time we did, talk about, are there macroeconomic buzz that is really impacting growth? You said we still need some more time. Could you call out some of those factors? Some of those factors among clients, conversations, the IT budgets have shaped up. You have a lot more clarity. So is there a macroeconomic headwind, so to say? And then I'll come to the others.
So today we don't see a macro headwind in the business. There's a lot of talk as we went into planning for this fiscal year. There are some areas, for example, we see manufacturing in Europe, which is showing us some weakness. We see healthcare, which is showing us some weakness. We see life sciences, which is showing us some weakness. But these are not across the whole business. Overall, we feel there's still robustness in our business, and that's what's reflected into our guidance.
One more, Salil, before I go to Pravin. 3-year roadmap, FY19, stabilizing the business, FY20, build momentum. So is that on, or would it take another year to, because you've ended this year on a strong note, but there are some concerns as far as margin pressures are concerned as well. So would you say another year to sort of see how you would want to stabilize the business?
I think from my perspective and our perspective, the business is today in a very stable situation. And in fact, we saw some of the early acceleration or building momentum already starting to come into Q4. With respect to the margin, as Nilanjan was sharing, our main focus there has been to make sure we invest in the areas that need investment for future-proofing our business. So that is the way we look at where our margin is. We also have some levers now which can drive operational efficiency into fiscal 20. So from a business stability perspective, my feeling today is we're in a much more stable place than we were 12 months ago, 15 months ago. We also start to see in different ways, if you look at our digital growth, 41% year-on-year growth in Q4, that's actually beyond momentum and acceleration. It's quite taking a real position in that market. So we will continue that. The 3-year journey for us, the roadmap is well laid out. And in fact, some of those things we are starting to hit sooner, but we've given ourselves the journey time of 3 years to make sure that we become really fully functioning in the sense of stability, momentum, and acceleration, even if some of the elements start to show up earlier in our trajectory.
All right. Pravin, in terms of financial services, last quarter also you said you're pretty upbeat as far as the demand is concerned. So is this a one-off affair? You had indicated that FY20 will look better. Do you still stand with that statement that retail and BFSI, the concerns will ease out?
Yeah. We are very comfortable with where we are with respect to financial services. This quarter, obviously, you saw a negative growth in financial services. If you look at banking alone, we had a positive growth, but on the insurance sector, we had a negative growth and it brought the overall growth down. But on the other hand, again, in insurance, if you look at it on a year-on-year basis, we have had a double-digit growth. So we feel very optimistic about it. Even in the large deals that Salil talked about, we had about 13 large deals, out of which 3 were from financial services. So we feel fairly confident on the back of all the large deal wins that we have had in the past, as well as the momentum and the pipeline that we are seeing. So we continue to believe that FY20, from a performance perspective, it will be better than what we have seen this year.
All right. Lastly, Nilanjan, in terms of margins, Salil also spoke about there are levers as far as operational efficiencies are concerned. Could you talk a little more about it? Because as far as, subcontracting expenses, we have seen the peers also highlighted over the quarter. Is that a concern? Investments is something that you have been making for quite some time. So what really are the levers that you have with you?
So I think from a first thing is on the pricing side, right? Sorry. So I think the first lever, of course, we have is on pricing. And as you've seen from our numbers, our RPP, which is a revenue per person, has actually grown on a constant currency by 0.2%. Now, of course, underlying that is, of course, in our kind of business, there are always pricing pressures, but you have other levers to make this up. So there's digital pricing, for instance, where you can command a premium. And I think we've also said that our digital margins are higher than our core margins. I think secondly, from an operational efficiency perspective, I think there are multiple levers which we continue to use. The use of automation in all our projects and how that can bring in efficiencies. How we use the onshore, offshore mix, how we started making now an on-site pyramid and more broad basing that. One of the advantages of the localization initiative in the US will be giving us an initiative and benefits on that. So I think we have multiple levers which we can use. Utilization, for instance, is something which we can use. We've seen a slight dip this quarter, but I think that can be ramped up. So I think there are multiple levers which we use and we will deploy as the year progresses. So I think that gives us confidence in the guidance which we've given.
Next question is from Bloomberg Quint.
Hi, this is Shivani Saxena from Bloomberg Quint. My first question to Mr. Parekh. While factoring the revenue growth, what verticals and services lines have you predicted will grow in FY20? The next question, kind of related. How are you factoring in the operating leverage and increased localization against rising wages and potential currency headwinds in your market, in your margin guidance? I'll come to my question now.
Okay. In terms of the growth, we're seeing really good traction, for example, in the way we see the telecom sector developing, the way we see the utilities sector developing. We have good traction in retail, good traction in the services business overall. So there are several segments, subsectors within our business that show us really strong traction. As Pravin shared, our financial services outlook for the full year is still quite strong, and that's a large part of our business. So those were some of the components that went in as we built the combination of our guidance for fiscal 20. The second one was?
So the second one is on the margin guidance. How are you factoring the operating leverage and increased localization against rising wages and potential currency headwinds?
So those are exactly the factors that have gone in to build the margin. And each of those factors has a role to play. There is obviously going to be wage increase within the fiscal 20 plan, but there's also a lot of focus on how we're building localization. We want to build out a new way of looking at the workforce, and that's part of the approach we're taking there. All of the FX factor, of course, we've kept aside. This is based on where we see spot FX today, so we don't factor that into our guidance.
Sure. In terms of the free cash flow, apart from buybacks and dividends, where else do you see investments? Are you looking at, where else are you seeing your CapEx going forward?
The CapEx itself, I think there are two parts to it. I think in terms of what do we do with the cash flow, it's certainly, we state our policy, which is up to 70% free cash flow, which will return to shareholders. And that's the approach we continue to use for fiscal 20 at this stage. On where we use the CapEx, we have a really lot of investment going into repurposing buildings, capacity for agile workspaces. So we've taken, in fact, large chunks of our locations, for example, in Pune, where we are putting a completely new development focused exclusively on agile. We are doing that in many other locations by buildings or by floors or sometimes by projects. And there's an overall plan that lays out where that's going to happen. And there's some of the CapEx, which is building out some of our infrastructure in the US as well.
Any acquisitions, key acquisitions and investments?
So no comments on acquisitions. As always, it's an active part of our review, but nothing specific to report today.
Next question.